Yeah, so I think one of the problems plaguing the property investment industry is that property investors, well, most property investors, 70% only buy one property, and the reason why that happens is because they get to a point where they have a fear of missing out, so they buy at the wrong time. The investment doesn't give them the short-term performance that they're after, and they sell it and they have a horrible experience. So one of the things and one of the reasons why I got into the industry is to help people not lose money. And that's just as important, and in some cases more important than making money. So I thought I'd talk about the things that not to do, and one of those things not to do is not to buy at the top of the cycle. So that's really what my talk is focused on: how to identify the top of the cycle, and then how and why to avoid buying there.
And you've got this fantastic clock where you look at sort of the property cycle and the construction cycle. And one of the things you talk about is that you should avoid suburbs where there's been 80% plus growth over the past 6 to 8 years. But doesn't that rule out pretty much most of Sydney and half of Melbourne?
You'll be off to Cairns then.
Yeah, look, it does. It does. And, you know, if you want to make money, I don't think Sydney's the place right now. I think long term, obviously, Sydney's going to be a great investment because it's one of the best cities, if not the best city in Australia. But in the short term, I don't see much upside in price because the local market, in my opinion, are priced out. The affordability index, which measures the average income going towards the average mortgage, is around about 58%, or at least that's the way we see it. So that means 58% of the average gross income rather, goes towards the mortgage. Take out 30% for tax and there's only 2% to live on. So Sydney's definitely not a place where we see short-term growth. The local market's priced out, and I think this year might see the absolute peak of that market. Melbourne's a bit different. There are some markets we believe in Melbourne that are past 12 o'clock, so heading into the downward phase of the cycle. But there are some opportunities in Melbourne. I still think that there's going to be 2 or 3 years of growth, and maybe 30 or 40% depending on which suburb you pick. So it's going to be very important to dissect Melbourne well.
Often when investors are looking at properties that they would, of course, then rent out, there is that wonderful expression, net rental yield. And I think for newcomers, these sort of expressions of income or loss are hard to understand. What is the equation to work out rental yield?
Well, simply you times the weekly rent by 52, so that, you know, if the weekly rent was 500 and you times that by 52, that's 26,000. And then if you divide, and that's the income, the total income for the year, and if you divide that by the value or the purchase price, you'll get the yield. And if the income's, or the rent is 500 a week, you times that by 52, which takes you to 26,000. You divide that by 500, say, if the property's worth 500, and the yield would be approximately in that situation, you know, about 5.2, 5.3.
So yield obviously is something you watch closely, and one of your sort of key points is that if that yield is going down over the past 3 or 5 years, that's another sign to you that it's a suburb to avoid, an area to avoid.
Yeah, because what a lot of people don't think about when they're looking at the yield is not only a measure of cash flow for the investor, but it's also a measure of the opportunity cost for renters to either convert into home ownership or not to convert into home ownership. So to give you a practical example, maybe 5 years ago, we were in Bondi buying a lot of property in Manly and Rose Bay and Double Bay. We sort of picked the bottom of that market, and the rent on a one-bedder was $500 a week, right? The interest-only mortgage repayment was $500 a week. The yield was approximately 5%. At the time, interest rates were 5%. And so what that meant in Bondi at that time was its dollar cost the same for renters to convert into home ownership, right? So the hallmarks of the bottom of the cycle is an ability for renters to convert into home ownership for the same price. And obviously that doesn't exist in Sydney right now because yields are so low, and it doesn't exist in Melbourne right now because yields are so low. But if you went to a market, say Adelaide, where yields are 4.5%, and the current interest rate's 4.5%, its dollar costs the same for renters to become buyers. So the market in Adelaide is telling renters to become buyers. The market in Sydney and also Melbourne is telling renters to stay renters. So that's why yield's important. That's why the trend of the yield's important, because it represents the opportunity cost for first home buyers to convert into home ownership.
And just on another sign is visits per property. That's another one you look at if that's trending down or low. Can you explain why that's important and where do you find that information?
So all these three statistics are on realestate.com. Right, so the past growth is on realestate.com, the yield and the trend is on realestate.com, and also the average visits per property is on realestate.com. So these statistics are free, they're available to everyone, and in fact they're actually on every single property listing that you click on realestate.com without giving realestate.com a plug. If you scroll down the page when you're looking at the photos, there'll be a section called Suburb Insights or Investment Insights into that suburb, and you'll be able to see these three statistics. With respect to average visits per property, what happens as prices become more expensive in a suburb, less and less people want to participate. And equally, when prices are very affordable, there's a lot of people that want to participate in the market at that level. So in the markets that we're buying in for our clients, you'll find that most suburbs have 2,000 unique hits per person or more, which is a lot. And that unique visits per property, I should say, those unique visits per property, if there's 2,000, that will convert into more people through the open for inspections, which will convert into more bidders, or that will convert into multiple offers, so creating competition in that market. When you look at a market where, take Glen Waverley for example, it's probably up 100% over the last 6 or 7 years, obviously of particular interest to foreign investors more so than locals. That market, I think it's gone from 600 to 1.2. It's doubled in the last 7 years, and now the average hits per property in Glen Waverley is down to 200. And what that tells you is there's very few people wanting to participate in Glen Waverley at that price point. So
wow.
it's a very good predictor for what's going to happen in the next 3 to 6 months. And if you can understand the trend, and if you can understand whether that is low or high, you can really get a gauge on which way that market's going to go.
My gosh, so much
avoid,
to pick up, so much to understand, isn't there, Brian?
Yeah.
That's why you want to go to the expo.
Exactly. David, thank you so much. That's been great, fascinating. Thank you.
No problem.
And
Wow.